All right, let's see if we can get this going. I guess first and foremost is I see there's a couple of viewers. Can you guys actually hear me? I guess that would help first. I just installed all of this, so I don't really know if it's working 100% or not. Okay, I guess it's good. Okay, so we're going to talk about the market wheel. I don't know if that's a trademarked term or not. It's just something I personally use to uh, discuss the intricacies between the various financial markets. So this is a very big way of how I trade. So I'm a technical trader, but I also use things like order flow, to a lesser extent, depth of market, but mainly I'm utilizing volume profile, technical analysis, and I'm applying those concepts to all the different various markets. All markets have a relationship to each other. So some markets are correlated in a exact way, meaning when bond yields, for example, go up or down, that generally relates to equity markets going up or down. And when there's divergence between those two, you then get an idea that, all right, something's going on here, whether that be yields might be going up and equities are going down, or equities are going up and yields are going down. That's creating what a lot of traders coin as the term Jaws, where you're going to eventually, at some point, whether it be a week later, whether it be a month later, whether it be 10 minutes later, those two are going to snap back to each other, doing mean reversion. And sometimes they'll meet in the middle. Sometimes one of them won't budge and the other one will correct all the way back down to the other one. Um, but it always happens. There's other correlations as well. Things such as bonds are generally opposite of equities. So if bonds are going on a massive rally, then you would expect, and again, doesn't always mean it's true. There's many times where bonds and equities will rally side by side. But at that point, one of them's lying. One of them is wrong, and then your job is to figure out which one's wrong. Uh, so there's opposite correlations and there's direct correlations on for every market. Another correlation is between the Nasdaq and the S&P 500. If the right now the Nasdaq is leading, you've got Fang that's I don't know the exact percentage, but it's some massive amount of the indexes that basically are able to prop up the entire market. So you've got situations where the entire, they can sell everything except their Fang, and they can still keep the market flat or even up. So, there's situations right now, the way that the indexes are set up, that if you're an index trader, you really need to not only be trading the index itself, but you have to be already looking at these individual stocks that are so huge that they can keep the index that you're trading up or down by themselves. So the idea of correlation between markets is nothing new. I don't want to say every real trader, but uh, you really should be looking at multiple things when you're trading versus just trading the index, because I mean just the way I just explained how the index itself is set up. So if you're not looking at multiple things, you're really doing yourself a very large disservice, because you're not getting the full data picture. You're only seeing a very narrow part of what's actually happening in the overall markets. And I like to say the more data you get, the better it is. Some people like to keep it simple, which is fine, but if you're going to put a keep it simple person next to someone that's both has talent but also is looking at much more than them and is able to process that information correctly, because just having the information doesn't mean doesn't mean anything for you. You need to understand the information and be able to act correctly on what the information is telling you. But if you're in that situation where you have someone that's just keeping it real simple, doing RSI and MACD, and they're buying low and trying to sell a little bit later, I'm going to pick that data person every time, just because you're able to make much better decisions very quickly and on the fly. So, anyways, I'll get to the questions in a little while towards the end, but let's get going. So right now we're looking at the ES futures. Everything I trade is off of futures. I'll reference the individual index occasionally, but the problem with those, like if I was to pop SPX in here, the problem with that is there's no volume data. So a large part of my trading is utilizing volume, right? So you find that volume using futures, right? So everything I trade is futures. But what we're going to do is we're going to just start talking about the various sectors in the market wheel. So obviously we've got equities, right? They include the New York Stock Exchange, the S&P 500, the NASDAQ, yada, yada, yada. Those are U.S. equities. Then you've got the Asian equities. You've got the Shanghai Composite, the Nikkei, the Japanese market, CSI, the Hang Seng. Those are pretty much the only Asian markets I'll look at. For the European markets, you've got the DAX. Europe is the eminent economic power in Europe, so or Germany is rather. So that's pretty much the only one I'm interested in. Beyond equities, you've got bonds, and in that subsector, you've got yields as well as individual bonds themselves. You've got currency, so you've got the yen, dollar. You've got individual breakdowns like the US dollar to the yen, as well as the Aussie dollar to the yen. You've got commodities. These include copper, gold, sometimes Bitcoin. You've got the flows, which is up volume versus down volume. So those tickers are UVOL and DVOL if you're on TradingView. And that's for the New York Stock Exchange. There's also the NASDAQ up and down volume, which can sometimes be more useful. But they're both going to be telling you usually something similar. You've got the risk, which is VIX, obviously, as well as VVIX, which is basically what's a good way to describe it? It's the volatility of volatility, meaning kind of like your down. What people trying to hedge the VIX for the downside type of deal. If that's it's kind of it's not that tricky to understand, but it's a little tricky, I guess, to say. Basically, what's just like you've got. Here's a good way to say it. You know, if you're a technical trader, you've got RSI, relative strength indicator, but then you've got stochastic RSI, which is an indicator of RSI, right? So RSI is an indicator of price action. You know, how price is moving, how quickly price is moving, how slowly price is moving, and then you've got stochastic RSI, which is an indicator of RSI, how fast RSI itself is moving. So it's an indicator of an indicator. So you can think of VVIX as something similar to VIX itself. So that's the market wheel itself. One second. It's been a minute since I've done. I used to stream all the time back in the day, like probably 3 years ago or so. I had like a daily market overview every day, but new computer since then, new setup. Haven't done it in years, so let me know if something is messed up. I actually couldn't get it to show my screen. I could only get it to show my web browser, so unfortunately, until I figure that out, that's how it's going to be. All right, so um, basically what I'll do on any given day as I'm going through the market is, I'm first and foremost I check my levels, yada yada yada. But the next thing I'm doing as we're going throughout the day is I'm trying to basically look at everything, right? So let's go over the watch list. Right now I got ES, which is the S&P 500 futures. It's on 1, which is the current contract month. I've got NQ1. Again, 1 is the current month, 2 is the month out of yada yada yada. This is for NASDAQ. I got RTY. This is for the Russell small caps. I've got ZN. These are the 10-year notes, bond futures. I've got CL, which is light crude. I'll also sometimes use US oil instead of this, but this is usually what I use. I've got the US 10-year government bond yields. This is the main yield that I trade against. I've got the US dollar against the Chinese yuan. I've got the US dollar versus the Japanese yen. I've got DXY, which is the dollar index. This is basically the dollar versus the basket of everything it trades against. So take the yuan, take the yen, take the Aussie, take everything and roll it into one. That's DXY, no volume information. I've got JXY, same thing as DXY, except this is for the Japanese yen. This is the basket of currencies, the overall data that of everything, of the yen trading against the dollar and Aussie, everything. It's all rolled into this. I've got VOLD, VOLD. This is basically you take the up volume and the down volume of the NYSE in this case, and it puts it in a nice little chart for you basically, so it gives you an idea of, is more volume exiting the market or is more money coming into the market. Got the VIX, self-explanatory. I've got the AUD JPY, the Aussie dollar versus the yen. I've got the 6J1, this is the yen futures. I've got SPY, self-explanatory. I've got FDAX1, this is the euro futures, the German market. I've got HSI1, this is the Hang Seng index. I've got the NKD1, this is the Nikkei. I have Tesla, just because it's a stock I watch regularly. Bitcoin to USD on Coinbase. I believe this is the highest volume. Could be wrong. If not, let me know. TVIX, this is being delisted soon, but it's good. I use this as a good sentiment gauge. The actual HSI index itself, no volume. Shanghai Composite Index itself, no volume. The NI 225 index itself, the Nikkei, Japanese market, no volume. VIX June contract, VIX July contract, SPX, which is the S&P 500 index with no volume data. Apple, for obvious reasons. TLT, the bond ETF. PCC, which is the put call ratio. VVIX, US oil, I mentioned briefly, I'll use that as well. USD to euro. The USO2Y euro USO2Y, the 2-year bonds yield. ZB1 again, T-bond futures. XAU USD gold. Got copper one, copper. CSI 300 Hong Kong index, and Vol Q, which is NASDAQ volume versus down volume. So when I'm trading on any given day, usually, if I'm up here, you'll see about 20 different tabs open. And on those 20 different tabs, I'm monitoring any one of these. Now, I don't look at all of these every day because sometimes it's not necessary. But what you will find is that oftentimes things correlate very frequently as the same thing. Meaning, right now, if you've been paying attention, the dollar index is a direct correlation to the equities index, and it's almost instantaneous. So if the dollar moves down 10 cents, the equities are moving up, 0.5% or something like that, right? Almost instantaneously, side by side. You can have both charts up and you can watch the action side by side. That's not always the case. Sometimes equity markets will be really, really sensitive to the yen market movements, right? Because maybe perhaps Asia is what's moving markets right now. Sometimes, as crazy as it sounds, sometimes other parts of the world move our markets for us. So sometimes you'll see that the yen correlation is really strong. Other times you'll see like the Aussie dollar and the Japanese yen correlation between that and equities, right? It changes. It's never one thing, right? So overall, eventually, you can count on, yen and dollar being up 99 times out of 100. That means equities should be down, right? When that's not the case, sometimes equities will rally with the yen as well as the dollar. then that right there is telling you something very important that you should be paying attention to. That's telling you that, one of these is wrong. Either equities should be correcting at this point, or the dollar and the yen, which are much, much, much larger markets, are wrong, which is at that point highly unlikely, right? So there's general correlations between everything. So generally speaking, right? And again, this you can't take this as the end all be all, because you're going to see once you start doing this that divergences happen all the time, every day, right? You're going to have things that are risk on and things that are risk off. That's my advice on how you handle this, right? You can create two buckets. You can create the risk on bucket. You can create the risk off bucket. And sometimes, like I said, almost every day, something in those buckets are going to be going against each other, right? And when that happens, you want to figure out why is that? Because if you can figure that out, then you can figure out the true direction of where everything else should be going, right? So one of the benefits of looking at literally everything I just told you is, a lot of people will look at the equities and then they'll compare it to the dollar and the yen and call it a day, right? Well, the dollar and the yen on Tuesday might be confirming the equities movement, right? But then you start shifting into commodities and you can see that copper and gold are behaving oddly. Maybe they're up as well while the dollar's up, right? Well, what's going on there? There's some sort of divergence happening there, because that's not what should be happening. Copper and gold are bought with US dollars. So that means if the US dollar is up, copper and gold should be down, because the dollars are worth more than what should be the case for gold. So having a large bucket of risk on versus risk off is very big, because it allows you to catch some things that just looking at the dollar index and the yen won't always show you. On Friday, this is a perfect example. Pre-market on Friday, the copper was up huge. So some of you may have heard the word Dr. Copper. Basically what that is that's used as a way to describe the overall health of the market, right? Sometimes people use it as a leading indicator, yada, 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 but it's by no means perfect. It can be very accurate sometimes, and other times it's not accurate at all. But you've got to look at it in the entire picture. You got to look at what is copper doing versus the US dollar, what is copper doing versus gold. You got to apply the entire thing to it, right? So copper was up huge pre-market on Friday, and then as soon as we started trading, it got hammered, right? I mean, let's pull it up. Let's see. So we started the day and I want to say it was somewhere up here. It's like 460 or some crazy crap pre-market. It got slammed all the way down throughout the day and ended the day with a doji, right? But if you're looking at that pre-market, that's telling you that all's well, the market's healthy, and that by itself is telling you the market's going to go up that day, right? But you got to take that with a grain of salt. You need to look at other leading indicators. So anyways, that's the market wheel in a nutshell. I can very quickly tell you what correlates to what. I'm pretty sure that'll be helpful. U.S. 10-year yields, you're going to want to look for a correlation between that and equities. If yields are up, you would expect to see equities up. If one of that's not true, right, that's some sort of divergence. Bonds are up, you can expect equities to be down. The Russell is a leading indicator, right? Small caps. So many times before major sell-offs, the IWM or the Russell small cap market will begin selling off, usually 3 to 5 days before it hits the rest of the market, before it hits the Nasdaq, before it hits S&P 500, yada yada yada. So that's many often, and oftentimes it'll rally, you know, 3 to 5 days before those markets, right? Oil, right? Oil's an interesting one. The correlation between oil has changed a lot. If you pop a compare on here and you compare it to the S&P 500, you can see that sometimes we correlate, like 1 to 1. Like if oil's up, equities are up. If oil's down, equities are down. That wasn't always the case. This is a more recent phenomenon, really. Used to be completely opposite. If oil was up, equities were down. But that's shifted, and now they're very, very similar. Oil being up, equities up. Oil down, equities down, right? So oil's been I don't want to say oil's been leading the market, but it's been, you can make a case for it leading the market, but I don't like to think that's the case. But you can make a case for it. A good example, would be right now. Oil started trading down while equities were still up on Friday, if I recall correctly, and within an hour or two, equities started trading down as well. U.S. 10-year yield, this is the one I like to use. I like to correlate this one a lot to equities. Basically, yields up, yields down, equities down, right? That one's a very good leading indicator. It happens all the time, where yields will start diverging from equities intraday, weekly, like you name it. Like it's a very good leading indicator. And sometimes it takes, the thing about yields is sometimes it takes weeks for that correction to happen, just FYI. It is not an instantaneous thing with yields. Chinese yuan versus equities. Usually if the Chinese yuan is strong, that's bearish for equities. Japanese yen to USD. So basically you want to treat the dollar as the yin to the yen with the yen itself, meaning you want to see the dollar and the yen kind of as two sides of the same coin. And sometimes this is a good, a lot of people use the USD to yen correlation to markets. Nothing wrong with that. It's a good one. It works. It's a leading indicator. You can pop the compare on right here and you can see it yourself that, what happens when it goes down. And, so some people use the inverse. Here you can see we're going down, it started going up, started correcting, and then, this warned you ahead of time that, there's going to be a turnaround. Some people like to use the inverse version of this chart. I don't know how you do that on TradingView though, but that's a popular thing as well. You see a lot of people do. We've got the DXY and the JXY, so the dollar and the yen index. These are the two that I find myself using quite a bit on any given day. I made a call, I believe last Thursday or something, where I said, it's a no-win scenario for equities because the way that the dollar and both the yen were set up created it as such. Meaning, if the yen went any further from where it was at, it was going to be breaking out and could go see the previous highs that it had while equities had their previous lows back in March, right? So that's a no-win scenario for equities. Then at the same time, the dollar was being pummeled and was starting to reverse. And right now, for whatever reason, there's a very direct correlation between the dollar and equities. It's immediate, right? You can compare it down to a 5-minute chart. That's how immediate it currently is, right? So dollar was starting to reverse, right? So that's in that scenario there, that's a no-win for equities. There's no possible way that equities could continue moving higher at that point without having headwinds from the currency markets. And the currency markets are much, much larger than the equity markets. You got VOLD. This is volume up versus volume down. This is for the New York Stock Exchange. You can use this for inflows, as I call them. You've got VIX. This is pretty much a perfect correlation between the S&P 500 and the NASDAQ. If VIX is up, 9 times out of 10, equities should be down. There's been occasions, especially lately, where VIX has been elevated and equities have been elevated as well. So that's just another example where somebody's lying. You've got the Aussie dollar to the yen. So right now this has been a leading indicator for risk on. So, as this has moved up, equities have as well. And you can see that here's the S&P 500 chart, right? Well, what do you see here, right? You see the Aussie dollar peaked right here, same exact day that the S&P 500 peaked. Then it went down, created a new low, same day that the S&P, that was that Thursday, hit that low. Then it started going back up, right? Just like equities, but made a lower high here. Started going back down, equities drifted down, nothing drastic, made a higher low. Had another little bump day here, we went up, and then we've been going sideways while equities have been going down, right? So this right here, you can see that there's a perfect correlation up until this point here, right, on June 25th. So, this tells me that this is something I'm going to want to start paying attention to, right? If next week I see that on Monday, this starts going up, but equities keep going down, right? Well, what's that telling you, right? There's something's diverging here. And again, currency markets are much larger than equity markets, so there's probably something happening there, right, that you're going to want to be paying attention to. Now, if this confirms, on Monday, it's just as likely that the Aussie dollar gets hammered at the same time that equity markets get hammered, and then all's well in the universe again, right? You've got yen futures. If you can see here, yen sold off while we went up here. Then the day before the sell-off began, the yen was rallying. So on June 8th, the yen put in a giant green bar here and proceeded to go up, and that coincided directly with the top in equities. SPY, I just use this for, whatever. It's good to have. FDAX, this is the German market. You can look for correlations here. You'll see that these are very, it's correlated exactly right. Here's the peaks. We go down, we go up, we go back down, go up, follow it all the way up, down we go, and you can see that. You can see the correlation for yourself. Hang Seng, a little bit different, but sort of similar. They're peaking a couple days late. They're a few days behind us. It can be due to time differences and all sorts of factors. But they're moving up. They're selling off. You can see how all this stuff works together, right? You got the Nikkei, same thing. It's like a picture perfect 1-to-1. Here's the peak. They actually hit a new high here, but then immediately sold off. Continued. It's going down. So U.S. markets, what's the story here? U.S. markets are going down, but you've seen multiple examples where even though these are having red days, they have not confirmed a further down move yet, right? So gotta be paying attention to that. You got Tesla. I'm not a fan of this company at all. I think I love their cars. I get it. It's cool. It's good technology. I might even get a Tesla myself. But when it comes to their accounting practices, it's just there's no other way to describe it besides fraud. It's as simple as that. The way they do accounting simply does not add up to what they're selling in inventory, what they're producing, how much money they're making. It's 100% false. So there's no other way to describe it. But anyways, you got Tesla, you got Bitcoin. So Bitcoin's been an interesting one because it used to be very risk off to risk on. Highly speculative. You're this new product, yada yada yada. And what's happened over, I haven't been following it. I used to follow it a lot, but I haven't been following it for probably a couple of years. But so I can't give you the exact time that it shifted. But what it seems like is now Bitcoin mirrors our markets quite a bit. So it's actually leading our markets, right? So here you can see that it peaked, started correcting, and then a few days later, when it hit the bottom, the S&P 500 started correcting, and Bitcoin started going back up, right? Projecting the next up wave. So it kept going up, starts correcting again. We're going flat, starts going back up. We make a new high. It looks like 1, 2, 3, 4, 5 days before on Bitcoin versus the S&P 500, and then it starts selling off, goes back up. You notice what's happening here. It's making lower highs, right? Makes a lower high. We start selling off, right? You can see that today. Yesterday it got pummeled, put in a hammer candle, but today it's putting in a green candle. I don't know if it's an inside day or not. It's not had a high. Is that inside day? What's the high here? 91.88, 91.89. So not technically an inside day, but for all intents and purposes, it still is an inside day, right? So it's interesting. There's about a 2 to 3 day delay right now, and this has been going on for a while, of Bitcoin leading equity markets, which I think is very interesting. TVIX is getting pummeled. By that I mean it's going to be delisted soon. I don't know the exact date, sometime in early July, I believe. So this is going to no longer be a thing. Chinese markets, again, same thing, about a day or so delay, couple day delay. Here's the Shanghai composite, which is not actually, it's going higher. You can see that's, they had their correction day when we started, and they're still going up, right? So some sort of force in Asia is keeping those markets up, which makes kind of makes sense. You've got the Chinese data coming out. Obviously, you can't really trust it, but on paper it looks really good. The only issue is that it's probably not true. You got the Japanese market here. something similar. You can see it peaked, started going down, came up, and it's going sideways now, right? I actually put in a hammer candle on Friday. Well, we made a new low, right? So there's now I've pointed out about 3 or 4 things. This is why I was hesitant on Friday, by the way. When I said I'm going short, but I'm hesitant. Uh, Part of it's because of this stuff, but the other part of it was that close was just insane. The amount of volume that came in at that close, there was very clearly someone desperate to get out all day. But at the same time, there was someone just as willing to buy, just as enthusiastic to take the shares at this price. So that's got me a little worried. And here you can see the more divergence from Asia. Got the VIX. It's putting in one of my most favorite setups, the inverted hammer. I don't have the trend lines on, but there's a trend line here. It actually bounced off that trend line, I believe, if I recall correctly. Put in a green inverted hammer. Here's a real kind of similar situation. Here's some inverted hammer. You see one here, right? You see one here. This isn't really one, but I guess you can classify it as one. But they work well. They work very often, and you can see what happened over here, right? So this is a very good sign, but we'll see what happens. VIX July, we don't need to go about that. Here's the S&P 500, the actual index, non-futures. You can take a look here. You can see that we closed slightly above the lows from June 11th, but chart doesn't look too good. Apple, this is the big one, right? So ultimately, this is what I was looking at when I decided, all right, we're gonna go ahead and stay short, right? Look at this candle, closed at the lows, engulfed. It's not technical engulf, but it took all these out. We're closing below this major support here. It's supposed to. Here's the thing: it's not a major support. It should have been. If we were going to keep going up, this should have been a major support. Let's put it that way. It went through it like butter. So, you've got the close that's in the wick of this high where they sold off, right? You got the close in the middle of this whole range. It doesn't look. It's not a good close, right? I'll be very surprised if Apple has a good day on Monday. Now it might have some sort of bullshit inside day or something like that, But if it breaks this, I'll be shocked. So inside day Monday is possible, but honestly, off of this candle, how bearish this candle is, you can see volumes increasing. You would want to see a pretty significant sell on Monday, and if you do see that, you can be confident that at least in the near term, there's a trend change. It might only last a few days, but you can see that there's gonna be continuous selling probably throughout the week. You got TLT attempting a breakout. I don't have any sort of, this isn't the only. I also use this sort of stuff, which you guys will probably look at and just be like, "Whoa, what is it?" It all makes sense to me. It's all that matters really. But we are attempting a breakout here. You can see here the highs, and then we had this whole low in a range, and we're trying to break out of this range as we speak. So if we get follow through on Monday, that's going to coincide with pretty decent equity sell. Put call ratio. This is what I used when I shared that chart that showed the different levels in the weekly. What the historical levels are. You can see that we're breaking out. Put in interest is increasing drastically versus the over here where the S&P 500 as we were making our way up to the high, there's very little interest over here. You can see that that's increasing rapidly. Still not at the peak levels that you see at lows. So we'll see what happens. You got VVIX, the volatility of volatility shows that people are a bit concerned. Also put in a inverted hammer. It's kind of a shitty one, but it is one nonetheless. Oil, same thing. It's been leading the S&P 500. Still had a pretty shitty day as well, but it's going sideways. It's in a range. It's not making new lows. So that's a potential another indicator saying that we have a inside day on Monday. Got the euro. I can't even see these candles, quite frankly. We have some dojis going on. It's funny how these works, right? See? Lower high. We'll see what happens. Where the hell was I? Got the 2-year. This thing will go all over the place all the time. I don't really use this very often. I just like to look at it every once in a while. But you can see the correlation 10-year chart looks similar. Yields have not budged from their lows while we've continued to go higher on the indexes. Bond futures are up about 0.5% right now from Friday, obviously. Gold is up. Gold's in an interesting spot here. So I don't think that gold is gonna make new highs right now. I could be wrong, but the reason why I don't think gold's gonna make new highs is because as this market crash happened, right? You got to consider two things here. The last market crash, what happened? As the market tanked, right? On the first down, what happened? Gold went up, right? Then when on the second down, people realized, oh boy, this is the real deal, and gold crashed just as much as the indexes crashed, and that's due to when you're facing downward pressure and you need to cover your losses, you've got to sell everything. So, a rising tide raises all boats, and yada yada yada. This is a similar situation, right? So if you're of the mindset that equities are going to have a major crash, then there's a good chance that gold will crash with it. The second thing is that when the markets were crashing, there was a rush to safety, right? Everyone rushed to dollars. They weren't rushing to gold. They weren't rushing to silver. They weren't rushing to Bitcoin. They were rushing to dollars. And that caused that huge demand for dollars, which put even more pressure on, as dollars rise, gold should go down. And, so you had double tailwinds happening, right? Or, sorry, headwinds. But the second thing is all the economies of the world are starting to reopen. So China has a dollar problem because when China wants to go and they want to go buy zinc and copper and silver and everything that they want to buy, they have to buy it in dollars because international exporters aren't going to accept Chinese yuan for their commodities. So you get this scenario where there's going to be huge, and the reason that is, by the way, is because that's the Chinese yuan is what's called a convertible, non-convertible currency. They set how much their money is worth every day on a daily basis. They say, all right, so today on Monday we're going to give you 7.08 yuan per US dollar that you're willing to trade, right? They set the price of their currency. The market, the free market, doesn't do it. So their currency is set and controlled by their government, which is why people call them, currency manipulators. So, China is a huge manufacturer. They're restarting, right? Right now, as we speak, they're restarting, right? So what is that going to do for the dollar? That's going to increase dollar demand. People are going to need more dollars to get the manufacturing and everything started again. And that's going to basically, in my opinion, keep a lid on gold, which is traded against dollars, keep a lid on those prices, right? So I don't think gold's going to make new highs. Could be wrong. I mean, from a technical standpoint, if you're just looking purely at the chart, looks pretty good. But if you look at the overall situation of what's going on, I think that dollar prices, as well as equity, if there is an equity correction, will force metals to the downside. But I like metals, but it's just I don't like metals now. So I think that in quarter one, quarter two of next year, I think metals will probably be the play. Copper, right? Copper, again, Dr. Copper is basically telling you that this is a leading indicator for the overall health of the economy. So, you can see copper is recovered. I think on Friday or Thursday, some headline came out that it was like, I forgot how much, but some copper headline came out that it hit new highs, hasn't seen since February or some crap. You can see that copper is diverging here, right? So here you can see that as equities were making a new low, copper kind of follows suit, and copper's has gone on and continued while equities made a new low. Copper's sitting here saying that production is resuming and the world is getting back on track. That's what this chart is telling you, whether or not you realize it. And at the same time that's happening, though, that also then means that what I just said about the dollar is happening. Dollar demand is increasing, even though the Fed is printing a absurd amount of dollars, right? Dollar demand is, this chart is telling you, is increasing because manufacturing is getting started again, and you need dollars to manufacture, right? So that's why, in my personal opinion, I think that the dollar is, in the short term, the dollar is going to rally, and that's also a combination of the European central banks are taking over the stimulus. So the Fed this week, the POMO is gone. There's 1.8 billion up to like 2.3 billion this coming week, right? There's going to be no POMO this week. Whereas the central banks of Europe are just blasting it right now. They're going full force, right? They're implementing the entire plan of what they were doing. They're the ones implementing it now, right? So I think that in the short term, that's going to create a headwind for the euro and tailwinds for the dollar, and then because the dollar is so closely correlated, uh, that's going to be bad for U.S. equities. Now, the way that can be countered is if European money starts flowing, into U.S. markets, which that can be a thing. You've got the CSI index, same thing. It just looks just like the copper chart, right? So again, you're starting to see the signs here. China is what? China's restarting. China is still going. So back here, you saw early reports that China perhaps was doing great. They came out the gate. They lie all the time, right? But this chart itself plus copper chart is telling you that China is resuming production and is starting to manufacture things. You got the Vald Q. This is just like the other Vald, except the Vald is New York Stock Exchange. Vald Q is the NASDAQ. All right, so this is my watch list. These are all the different things that I look at on any given day, on any given minute. And you'll start learning their tendencies and what goes up when the other goes down. I gave you a brief overview of that. But the only thing the only way you're going to learn this is by looking at them yourself all day, every day. In terms of my technical trading, I use this. I use levels that I create. Nice, easy charts. This is one of the main charts I trade off of. I create, I use volume profile analysis quite a bit every day. And then I also do from important pivots. So I might do from the high here down to the low, or I might do from the high all the way to the current. Just sort of depends. I like to do the swings. Do from here, the low, to the high. You get an idea of what's going on. So you want to do swings and you want to do daily. That's how I come up with levels. There's no sort of secret. It's just you pop those things on and you'll see that price reacts at various levels, and over time you get better at it. You get better at saying, all right, well, that's likely going to be one that sticks, or that's not going to be one that sticks. So that's how I get my levels. And all day I'm trading off of this. I also use a shit ton of price action, so candlestick trading. And then also if you zoom in, the session volume is great, because what you can do you can see actual contracts that pop up, right? So as you're going throughout the day, this is a form of your order flow, your DOM, all that sort of shit. As you're going throughout the day, you can see where the interested buyers are based off, all right, are people buying or selling here, right? You can see the actual market orders. You can say, all right, some guys wants to sell 30 here, market order sell 30. All right, well, guy's got a reason to do that, right? Well, back over here, I remember there was some guy that market bought 30, right? So you can start seeing the pictures to the puzzle, utilizing all of the volume profile analysis, depth of market. You put depth of market on, and that sort of thing, right? So that stuff's helpful. You can use this program called Sierra Charts if you're interested in TPO charts, all that sort of stuff. But all right, I'll try to answer some questions now. I'll try to scroll up, start from the top. What bond yield do I find most important? I usually use 10. I don't know what whole in general means. Preferred time frames. I like the way I trade is I'll use the weekly, daily, 4 hour. If it's a stock, I use 65 minutes because we have a weird, the market starts at 9:30, ends at 4, right? So that you got to use a 65-minute chart, not a 60-minute chart. If it's futures, I'll use a 60-minute chart. Then I'll use a 15, a 5, sometimes a 3, and sometimes a 1. So when I'm looking to time my entries or my exits, I'll use the 1-minute time frame. And what I mean by that is as soon as we approach, before the day even starts, I'm putting the levels on the screen that I'm interested in, right? So as soon as as soon as price gets near these levels and I see that it's at those levels, I'm going to pop on a 1-minute chart because I'm going to start looking for both an increase in volume off of those levels and reversal candles, right? So when that happens, and I know that this may or may not be a significant level, I'm going to use a 1-minute chart to try to time my entry as best as I can, right? When we're just going throughout the day and I want to start figuring out when momentum's ending, I'm going to use a 5-minute chart. When I want to see when momentum end or beginning is sticking and is actually valid, I'm going to use a 15-minute chart. When I want to get an idea of the intraday trend, whether that be up or down, I'm going to use an hourly chart. When I want to get an idea about the past few days action, or mainly overnight action because of how futures have been, I'm going to take a look at a 4-hour chart. And when I want to get a big picture of where we're at, I'm going to pop on the daily and the weekly charts. When I describe sell orders as being absorbed and suspect it's the power plunge protection team or something, first of all, I never suspect that it's the PPT. Let's just throw that right out the window, right? I'm not a fan of those sort of conspiracy theories, right? They don't need the PPT to do it. It's not the PPT to do it. It's the PPT enabling fund managers and institutions to do it. It's nothing to do. And the way they do that is they take reserve requirements off their balance sheet. So there's all sorts of laws where you have to have X amount of dollars in reserve, in case shit hits the fan, like 2008, right? And what the Fed is doing is they're taking their balance, just on Friday, they actually got rid of them. They got rid of the Volcker requirement and said they can have infinite leverage, essentially. That's what that article came out when I was like, oh, Max Long, right? And everyone's like, oh, I had to delete it because I don't want people to FOMO. But that's basically what that means is banks can lever up to infinity now. That's what the abolition of that law means, right? So anyways, it's not the Fed. The Fed is taking their, they're taking the shit off their balance sheet that they would normally need to have, allowing them to take that money that they previously reserved and then do with it whatever they want to do with it, whether that be equities, bonds, whatever, right? That's all that's happening there, all right? So in a roundabout way, they're enabling it, but it's not them doing it. What signals am I looking for? Well, so that's, I can't show you that. That's not something I got to sit here and trade and observe what's happening and all that sort of stuff. I can't just say, oh yeah, so this is what I look for, right? Because what I look for on Monday might be completely different than the thing I saw on Friday that allowed me to come to that conclusion. All right, it's because of things like I'm looking at everything, I'm looking at every single one of these tickers, and then I'm looking at the buy orders, I'm looking at the sell orders, I'm looking at the price action, I'm looking at the overall trend. There's no, hey, follow this equation and you'll come to this conclusion. That doesn't exist in this game. Then you've got, what does the 2-year show you? 2-year just shows me the short-term yields, right? So they're trying to keep the 2 and the 10s. They don't want them getting out of control because you've heard of all this yield, the YCC, the yield curve control, and all this sort of stuff, right? I just like to have that up. I've got a whole chart dedicated to the 2s and the 10s actually, somewhere. Oh, this is a good one too. I'll show you guys this one. So this is the 200-day, every stock above its 200-day average. This is every stock above its 50-day average, and this is every stock above its 20-day average, right? So you can kind of think of this as a short-term indicator, right? So right now, below the 20-day average, it's in the buy zone. If I'm a buyer, I want to be down here. For the 50-day average, right, you can see that, well, most of them have sold off and we're not yet in the buy zone, right? The most powerful one is the 200-day. Now you can see here that on this entire bounce, very few stocks made it back above their 200-day average, right? And instead, they've gone back down and they're rolling back over. All right, why is this? Why is this a thing when stocks are back at their all-time highs and the index is up here and yada yada yada? This is because of index weighting. The way they weight the index, where certain stocks are more weighted and valuable inside the index than others. You can get bullshit like this, where the entire market is down. The entire market never recovered, yet, where the indexes themselves are back, way above where they were previously in some cases. Anyway, I don't know where the 2s and 10s chart is, but I've got one. It's a good one. What's the blue staircase indicator you use on the chart? That is developing POC or value area. I think it's developing value area. Yeah, so value area is volume profile. That's these little boxes here, right? So we can turn this off. All right, so this is what a chart looks like with no candles, just volume. So the little lines are developing areas where they're not fully formed, but they're saying that this is going to be significant, right? So this is the developing area of the value. So value is where 70, the way I have it set up, you can set it up however you want, but the way I have it set up is 70% of all trading is done within this area. Then 30% of the trading is done in the less, it's not colored in areas. All right, so this represents 30% of all the shares traded on any given day were done in this area, where then 70% for that day were done in this range. So this is called value area high, right? So it means you want to sell in this area. This is value area low, meaning you want to buy in this area. And then the majority of time, price was floating around these areas. Divergence starts a few days before, makes a lower high compared to equities. I'm not sure what you're talking about, John, but I'm sure it's true. I just don't know which chart. Gonna pop up in that scenario. Huge fan, about Friday, about seeing decoupling of China. Was it seen through these indicators? Nope, it's not. There's an actual meeting that said we're bringing jobs back and we're gonna start training everybody and not require degrees to do the work. We're going to start up the trade schools and we're going to start manufacturing again. So that's something the Trump administration is starting to do. So that's what I was talking about, the decoupling. What does the data cost per month? You have to be way more specific than that because I spend about $500 or $600 on all sorts of different data every month. Inflows, outflows, you can use the VALD or the VALDQ ticker. How many days out of 10 do you make money? How does this compare with when you started out? I don't know, just depends all the time, man. Sometimes I'll hit a home run on Monday. On Tuesday, I might strike out. Get nothing. When I started out, I had wild swings. So I would go from, $10,000 a day, down $20,000 the next day, up $10,000 the next day. Whereas now I'm much more consistent, and that's pretty much due to trade rules, trade management, risk rules, all that sort of stuff. How do you use the technical aspects, volume dollars versus equity side, to sniff out breaking news stories? I've often been able to see the signs beforehand. Well, it's the same way you just described. So you gotta screen time. You gotta look at all this stuff, right? You gotta look at the way, suddenly if there's some interested buyer at, let's say that you're on 3,000 SPY, right? And there's some interested buyer here that suddenly is chomping up 100 contracts at a time, right? But we were just at 2970 20 minutes ago, right? And there was no buyers. It's just sellers stopped selling, right? So price, someone buys 5, someone buys 10, someone buys 20, right? Price starts moving up, and no interested buyers down there, and but the sellers simply didn't want to sell down there, right? But then all of a sudden we get back up to 3,000 SPX, SPY, whatever you would call it, and someone's chomping at the bit, can't wait to get in, buying everything that sellers have to sell. Well, why is that? What's the reasoning behind that? There's a reason behind that, right? So that's how you can start figuring out, like, oh, okay, well, there's something's about to happen here, because all of a sudden when we were 30 points lower, no one gave a shit and wanted to buy it, but we're 30 points higher now, and suddenly, there's a very, very interested buyer. All right, well, chances are there's a reason behind that, right? So could be just, they got to break through the wall there, and now's the time to devote their capital to do it, or there's a piece of news dropping, right? There's no way to quantify that, right? Like you got to look at it, and you got to be thinking about it, what you're looking at, Like there's no, a lot of this stuff there's no way to say 1 + 1 = 2. It's not a thing, right? It comes with experience. It comes with screen time. It comes with staring at this stuff and understanding how it works, what doesn't work. What sort of trading rules do you use? Do you have books or resources? You can look up, what the hell's that book? Disciplined Trader. It's a good one. It's a mental aspect of trading. It's important. Ong Hen Hu, is that how you say it? Ong En Wei? Who? Am I saying it right? I'm sorry if I'm butchering it. What about DICS and GEX? Do you have a ranking of which indicators are more important? I use DICS and GEX sometimes, but it's not my end all be all. It's just another data point. DICS generally, you see the DICS in it, the DICS. It materializes supposedly 3 months later or something like that. Whereas GEX is supposed to represent a immediate action in the market, right? So the DICS is supposed to materialize. If you got 5 days of buying, supposedly that means 3 months later, price is going to be higher X amount of times out of 10, right? Then Gex is supposed to represent the gamma buildup, and we're going to start getting into some real complicated stuff here. So I'm not going to go too far into it. We'll save it for another video. The structure of the market itself, right? So Gex is basically trying to capture gamma's current structure for the current OPEX as well as all OPEX's option expirations beyond that. That's what Gex is trying to capture, right? So basically market structure. And so you're able to then use that, especially in times where there's weak market structure, to have immediate forecast of moves, right? So if the Gex is down a bunch, then you can probably expect the next day will be down a bunch. The Gex is up a bunch, you can probably expect the next day's price action to be up. And again, that's due to the way the current structure of the market is the options market is very weak right now. There's not a lot of interest, not a lot of calls, not a lot of puts, not a lot of money in the options market. So you're able to pin really easily. That's why we got that 30-50 pin to the dot on Thursday. That was go look up the options data. That was because of options. So that's what Dix and Gex is. Dix think longer term, Gex think immediate term, and then supposedly it's supposed to include dark pool and all that sort of stuff. The thing about dark pool, guys, is hedge funds bought the top back in February. All right, and hedge funds also use dark pools. So you have to take that data with a grain of salt, right? Like you have to interpret the data. You have to see the data for what it is. Just because a bunch of people are buying here doesn't mean that the market's not going to correct, right? Just because a bunch of institutions are buying here doesn't mean the market's going to correct, right? If anything, you want to track commercials. They seem to always be on the right side of the trades. But funds tend to lose a lot. Yeah, maybe I'll have a video about how to configure TradingView and all that stuff. Seems most people have their own way to determine support resistance area. What's the most common way to decide about them? All right, well, that's when I say buyers need to step in right now, that might have something to do with a level. That usually has nothing to do with a level. That's just got to do with the fact that if buyers don't step in right now, this monster seller that's been chunking 100 contracts for the past 10 minutes nonstop, right? And there used to be 50 interested buyers, right, that are buying 50 contracts. Now that's dwindled down to one buyer that's buying 20 contracts at a time. That's going to break because the dude that's selling is still selling 50 contracts, right? So you're able to determine that, in that scenario, bulls need to step their game up immediately, or sellers are going to, overpower them here, and the level's going to break. So that's nothing to do with necessarily levels, right? It's just that's to do with monitoring. That's volume analysis, monitoring how much is being sold versus how much is being purchased versus how much is being absorbed. If I see someone that's just boom, 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 these people are just desperate to get out, right? But someone just keeps putting stuff on the bid. If you got 50 people that want to sell a contract and they're all trying to get out, but there's a guy that's sitting there selling the 50, his 50 gets sold into, but then he's willing to buy another 50 right behind it, right? And someone keeps selling into it, right? Well, what's going on here? The guy's going to sit there as long as you want to sell to him. Because if you want to keep selling, if he wants 10,000 contracts and there's someone willing to sell him 10,000 contracts there, he's just going to, if I'm him, I'm just going to keep putting, all right, this guy, they keep trying to sell 50. So I'll put 50 on the bid. All right, that's 50 sold. I'm going to put 50 more on the bid. All right, that's 50 sold. Oh, okay, 50 more on the bid. Okay, they're still selling. I'm going to put 50 more on that bid. And I'm going to keep getting filled, 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 aka absorption. And then what's going to happen is, all right, well, it looks like, I'm not, now they're only selling 10. They're selling 10, this and that, blah, 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 right, right. Well, the sellers are done selling. I started to get what I want. Now that I can no longer get what I want with you selling into me, I'm going to start buying from you. I'm going to drink your milkshake. So then I start market buying, market buying, market buying to gain the inventory that I want. And that's how price will then move up. Price moves up or down due to market selling. If I put an order on the bid or the ask, that's a limit sell. Price will not move unless someone takes an action to take that from me. If no one takes that action to take that contract I'm willing to sell from me, price will not move. So price simply moves by the action of market buying or market selling. Yep. But anyways, guys, it's a good first video. I don't know 100% how to save this. I don't know if it's going to be saved automatically or what. I have to figure it out. I did Twitch, never did the YouTube. So I appreciate it if you want to hit the like button and the subscribe or whatever it is these people say. And pass it around. Tell your friends, I guess. That's the best thing you could do for me if you appreciate it. I'm going to try to save it. I don't know how to... I don't really know how to do it, but I'm sure I'll figure it out. And until next time.